Sure.
All right, if you're just joining us, we're just going to give it a few more minutes for a few more people to come and join us. Just a few more moments.
Peter, if I may just add, there were a few people that asked if we could send the recording out.
Yeah, of course. This is being recorded,
on.
so everybody who is interested in getting the recording will receive it at the end of the day. All righty, so I'm going to go ahead and start, and the people can just trickle in here. So good afternoon, everyone. I'd like to welcome you to today's webinar, Immigrating from South Africa to the United States through EB-5, Planning, Taxes, Estates, and Investments. It will be presented by our guest panelists, who we are extremely grateful to have with us today, Mike Abbott, Niel Pretorius, and Sonia Clark. Mike grew up and studied in South Africa, following which he began his career at Investec Private Bank. In 2006, Mike founded the property and lending advice division of Sable International. He now runs the Sable Wealth business and is head of the investment committee. He is based in London and leads advice related to U.S. connected persons. Niel grew up in Plettenberg Bay, South Africa. After gaining admission as an attorney in 1999, he practiced law for 9 years. He then discovered he wanted to switch careers and ended up qualifying for specialization in offshore financial services in 2008. Niel joined Sable International at the start of 2016 and leads the cross-border technical advice for Sable International. He splits his time between their Cape Town and London offices. Mike and Niel are joined by FPP's Regional Director for South Africa today, Sonia Clark. Sonia has been part of First Pathway Partners team since 2018 and has helped investors immigrate to the United States to help achieve their American dream. She has over 12 years of experience working with immigration attorneys and acting as a liaison for many chambers of commerce, embassies, and bilateral trade between countries such as South Africa and the United States. Throughout this webinar, you will be able to submit questions in the Q&A box located at the bottom of your screen, and we will answer those for you live. This webinar will also be available on demand to registrants. With that, I'm going to let Mike, Niel, and Sonia take over and moderate the forum for the rest of today's webinar.
Thank you, Peter. I would just like to thank everybody for joining today, and also our very special guests, Mike Abbott and Niel Pretorius. As we all know, they are extremely busy currently and have taken some time out of their day to share their valued experience, in terms of, the topics today when leaving South Africa and then also arriving in the United States. I'm going to hand over to you both, Niel and Mike, and thank you very much. Over to you.
Thank you, Sonia, and thank you, First Pathway. Hopefully we can provide all the listeners and the viewers with some help and demystify some of the issues attached to immigrating from South Africa to the US. So firstly, I'll just walk you through a quick introduction as to who Sable Wealth is and the Sable International Group. And this would be the moment. There we go. There we go. Right. So we're going to talk a little bit about the cross-border financial planning aspects of migrating from South Africa to the US. Right. So firstly, talking a little bit about who is Sable Wealth. We're a small team of financial planners. We've been helping clients do the financial planning, the tax planning, the investment management of their assets from one country to another when in transit. So we grew up really looking after South Africans and Aussies and Kiwis in London as they were moving between home countries and the UK. And over the past 8 years or so, we've seen South Africans moving all over the world and have been helping them understand the issues as they arise, which are often related to things like domicile and tax residency, double tax treaty issues, how and where to place investments to allow for trusts that have beneficiaries in multiple jurisdictions. So these are the types of things that we deal with every day. And my colleague Niel Pretorius, who heads up the technical team in our team that deals with cross-border, we also, by the nature of our clients moving from South Africa to other parts of the world a lot of the time, we have to grapple with the issues of South Africans exiting from South Africa, what they have to deal with first on the South African side, and then how that might affect their arrival on the US side. So we're going to walk through first the issues of exiting from South Africa and then deal specifically with the US side issues. So I'm going to ask Niel to cover the exit from South Africa issues, and we'll move on to that slide now. Niel, you want to take over from there?
Yep, thank you, Mike. Yeah, I mean, it's anytime people move, the one thing they have in common is dealing with SARS and SARB exiting South Africa. There has been quite a bit of changes in the space in the last couple of years. The first change we saw really was the abolishment of what we used to call the financial immigration through the Reserve Bank, which has now been morphed into a tax immigration process with SARS. The system pretty much works similar as previously in terms of what you have to provide and the process you have to follow, except that you're no longer having to deal with both the Reserve Bank as well as SARS. It's now a SARS-only process. The main thing that you would require when doing this exit from South Africa is you have to get a tax compliance status for immigration. There's a number of administrative requirements that SARS want you to follow and documents that you have to file in order to obtain the status. The first one is to get this TCS is you've got to provide your assets and liabilities for the past 3 years. You've got to provide proof that you've ceased to be tax resident. And that's in South Africans having grown up in SA, moving permanently, that is typically showing them that you've broken the ordinary residence test. Alternatively, that you are treaty resident in a different country, in this case, the USA. You have to give them further information on confirmation of what retirement funds you have, any insurance policies you may have. If there are trusts in South Africa, full details of that trust. It involves informing SARS about the beneficiaries, the settlor, the underlying assets, as well as financial statements of that trust. And in moving funds offshore, you have to show them the source of capital, be it from loans, be it from donations, savings, shares, and the like. You have to go through the full process, not materially different to previously, but it's a lot of work, and one needs to actually start quite early in gathering all this information to be ready for it. Changing your tax status, you can do that in one of two ways effectively, either by filing a tax return and noting it in that tax return. The alternative is you can actually do it through e-filing. Again, having to submit all of this information, I would suggest to people to actually approach somebody that does their tax or is capable of doing this process for them. That is one thing you don't want to get wrong. And if you do, it can have tax implications down the line. So rather see somebody who's au fait with the method of doing this, get it done right the first time, because the first document you would want from SARS once you've completed this process is actually applying for confirmation of non-resident. That is something that they would always want. Any retirement fund providers and other people wanting to transfer funds abroad is going to ask for that document specifically. Failure to do the tax immigration can have issues for you. So the simplest, most common aspect where this arises is on the exit CGT, which I'll get to in a moment. If you don't do this in time, what you can end up facing is interest and penalties on CGT, which should have been declared at the time you left, but never did. So that's something you don't want to carry on down the line. And previously, we were able to immigrate people retrospectively, and SARS is seriously looking at this and actually cutting that off. So somebody who left 5 years ago and now doing their financial immigration or tax immigration can have an implication that you can't go back on the asset values for by 5 years, and you would look at the current values to determine those taxes. So it hasn't come through as yet, but there's a very strong possibility that that might occur. Probably the biggest thing that people face in leaving South Africa is the exit CGT. Okay, so you are deemed to have disposed of all your assets, your worldwide assets, on the day before you have left South Africa. Why it was done in this way, it's quite simple. If it's the day before you leave, there is no tax treaty which can apply, as you cannot be resident somewhere else the day before you leave. The assets that it applies to is typically all your assets that will attract CGT in the normal course. There's some certain exclusions, such as immovable property in South Africa. That is not affected. You pay the CGT as and when you do sell the property in real terms. Tax-free savings accounts, endowments, retirement funds, and the like, equally not taxable. It is a cash flow event often if there are items at play, such as private company shares, and people don't intend selling those shares. So if you've built up a business in South Africa, you exit, you have to pay the CGT, even though you haven't sold the business. So you need to plan for the cash flow event that takes place at point of exit. It also includes any foreign immovable property that you might have. So if you've got a house in the States or flat in London, you're not selling it, you still have to pay the CGT. You can't get around that. Investment portfolios, same thing applies, CGT on exit. Timing your exits, there's a couple of ways you can play it. The best way probably is to try and time your exit early in the South African financial year. Simple reason is that if you're not receiving any other form of income, the capital gains tax is linked directly to the amount of gain and income that you receive. So SA basically takes 40% of your taxable gain and adds it to your income. There's no other income and there's only gains, you can potentially lower that rate from a maximum of 18% downwards, depending on the size of the gain. We also regularly come across people that's got what we term as tax preferred investments from a South African perspective. These include tax-free savings accounts and also very common endowments, be they onshore or offshore. Tax-free savings accounts, only tax-free in South Africa. So in the States, you will get taxed on that, irrespective of underlying investments that it might be. The tax-free status applies to South Africa only. Endowments, very common, as I said. The big issue with endowments are that you are not the taxpayer. The life company which holds the endowment is the actual taxpayer, and they are taxed in terms of what we call the 5 funds approach. So they pay income tax at 30%, capital gains tax at 12%, and that is irrespective of your resident status. If you become a non-resident, that tax will always apply in South Africa, and you may face further tax in country of residence. So if you're looking at the US will tax you on the net gains in any event, and you still pay that 12% gains in South Africa or 30% on income. Those are the main items that you have to address when looking to exit. You don't want to have ongoing tax exposure in South Africa where you've got the exposure on the other side. So looking at deemed disposal is one way, but you probably likely rather look at actual disposals. The second issue with the exit tax and the deemed disposal is the fact that the treaty, once you're a US tax resident, assigns the taxing rights on gains to the US. So any exit tax you have paid is irrelevant as far as the US is concerned. So if you have not disposed of an asset, so you're now dealing with a deemed disposal, at the point of actual sale down the line, you are faced with the US tax, and the previous tax that you paid in South Africa on the exit, kind of bad luck. You don't get that back. The treaty between the US and South Africa is fairly old. It comes from 1997. So it is pre-CGT in South Africa. South Africa moved to residence taxation, basis of taxation early in the 2000s, 2001. And the treaty has never been updated. There is no real impetus from either country to try and update it. South Africa still gets the gains and exits, and the US still gets the gain on sales. So it's kind of irrelevant to both parties, and this treaty has not been updated. There are some that have been, typically your new treaties, but the US is not one of them. Other items to deal with, something like retirement funds. You've got options when you leave, depending on the nature of those retirement funds. If it's something like an RA specifically, so a private pension fund, or private retirement fund, you cannot access those for a period of 3 years after you've become non-resident. Pension funds, you can do full withdrawal still if you have allowances available. Living annuities cannot export the capital. So at best with a living annuity, what you can do is expose the underlying portfolio to an offshore investment, which is dollar denominated at the end of the day. So you can get away from the rand risk firstly, and secondly from the South African Inc risk by moving the underlying assets offshore, but the annuity itself remains a South African investment. Once you're in the States, then we start looking at the treaty in terms of how you are taxed on any assets that you might still have in South Africa. So the treaty deals with various forms of income, from retirement funds, dividends, interest, capital gains, and the like. Typically, you'd look at the country of residence as having the primary taxing rights, with some shared and or potentially exclusive taxing rights in the country of source. So if you look at something like capital gains, if you're living in the US, only the US has the taxing rights, South Africa do not. Same applies to interest. Something like a retirement fund, the US-South African treaty has a slight quirk to it. It's not assigned exclusively to either country. And there's actually a time test that you have to go through. It's a 2 and 10-year rule effectively. So if you've been outside of the SA for less than 2 years, you would still be taxed in South Africa. The US can tax you on top of that, subject to credit, but they'll basically look at your work history in South Africa, and there will be a point in time where there'll be a flip over, and the US may become have the sole taxing rights on that. Something like life annuities, again, there is exclusive taxation as far as that's concerned, where it applies. It's not something we see a lot of these days. Another issue to consider, trusts. So a lot of South Africans moving off abroad have trusts in South Africa. A lot of them have property in them, be it business property, be it holiday property and the like. Trusts become extremely complex as far as the US is concerned. Mostly to do with what is underlying, and Mike will deal with that in a bit more detail when he comes on. But equally, from a South African perspective, the way the trust and the beneficiaries are taxed goes through a bit of a change. So firstly, SARS, if you are a trustee, SARS will insist that the majority of trustees have to be South African resident. So if you haven't got sufficient numbers, you may have to appoint an additional trustee in South Africa to ensure that that trust has not got any residence issues, whether it's residence in SA or now the US. So that is one thing that they will insist on when you do immigration. Secondly, from trust in South Africa, we are used to what we call the conduit principle, where income and gains from the trust is distributed to South African resident beneficiaries, and they are ultimately taxed in their personal capacity. So the trust doesn't pay the tax, the beneficiary does. When you become non-resident, that picture changes. So income can still stream through and the beneficiary get taxed on that, but that doesn't apply to gains, simply because the non-resident beneficiary is no longer subject to CGT in South Africa, which means the trust is taxed on any capital gains. So your rate immediately moves from a maximum of 18% to a flat rate of 36% as far as gains are concerned. Something to be very aware of, and underlying investments outside of property, to be very careful in terms of how that is structured to avoid any complications and punitive taxations as far as the US is concerned. Estate duty, federal estate tax, which is the US equivalent of estate duty in South Africa. There is a specific treaty, come from 1947, so pre-Republic days, still days of the Union. And it provides various rules in terms of who's got the taxing rights when it comes to estate duty. And that's largely dependent, A, on domicile, and B, on the situs or location of those assets. So different assets have different implications. Typically, you can treat it on the basis that where the asset is situated, that is the country that will have the taxing rights. But it gets more complicated when you have assets located in neither country. So if there's assets, for argument's sake, in the Isle of Man or in Europe somewhere, different rules can apply, and the treaty seeks to try and give some clarity as in respect of who's got that taxing right. Equally, when you look at a concept of domicile, various rules apply. South African domicile is fairly straightforward, and it's basically equivalent to the ordinarily residence test. So it looks at this as your permanent home. And the different factors like where's your wife, your kids, your dogs, your cats, your goods, where's your lifestyle. If that is South Africa will deem you to be domiciled. The US concept of domicile, there's a bit of a split there in the sense that you've got both federal domicile and you can have state domicile, and that's got implications from a tax perspective. A US domiciled individual has a lot larger exemption from estate duty in the US. At present, it's just over $10.5 million. Whereas in South Africa, we know the exemption is 3.5 million rand only. But you have to be deemed to be a US domicile for that larger exemption to apply. If it does not, you've got $60,000, which doesn't go a long way. A US domiciled individual, generally 3 classes. There is a US citizen, always deemed to be US domiciled. Green card holder, there's a presumption of domiciled, which is rebuttable. And then thirdly, a non-domiciled individual. Also, if you're not domiciled in terms of one of those two, you can be deemed domiciled if the facts so supported. So again, similar factors to the ordinary residence test in South Africa, in terms of your way of life, your lifestyle, your ability to remain living in the US, your location of your personal items, etc., comes into play to see whether you meet the domicile test in the US. If so, and South Africa perhaps still regards you as domiciled, that's where the treaty comes in and says who's got taxing rights where. Some states have also got domicile rules that all differ to an extent, so one needs to be mindful of which state is your domicile at the end of the day. You often have people in the states domiciled in one state but actually resident in another. So that is something that can happen and something to bear in mind of. Less of an issue than the bigger federal and South African estate duty implications. Again, rather have the US domiciled if you're going to move. As I said, the exemption is quite a bit bigger. It's not 10.5, actually, it's 11.4 million, that I remember correctly. But the key to exiting South Africa at the end of the day is make sure you do your planning well in advance. I'd say at least 6 months. Start looking at what are my implications specifically from that exit tax perspective. It can be big numbers. It can be a big tax flow event, a cash flow event. So one needs to do that well in advance. Assets that you can liquidate, the idea is always rather liquidate them actually, pay the CGT and be done with it. You're paying the CGT in any event on the deemed basis, but if you then later go and sell, you're facing CGT again and basically end up being double taxed. So where you can rather do actual dispositions, you can then invest in the US, start that capital basis from a fresh and take things from there basically, and then deal with the US taxation implications. Get rid of SA, you don't want those ongoing exposures down in SA. Mike, I don't think I've missed anything just on the exit. Let me just double check my notes. Yep, I think that is it from my perspective. Hand over back to you.
Thank you, Neil, for that comprehensive overview of exiting South Africa, and the word tax was used quite a few times there, so this quote looks very appropriate at this point. Moving on to the issues around the US itself, arriving in the US. And just to sort of highlight and link this to some of the things that Niel has said, the US has got a very unusual tax code in the way that it quite onerously taxes US domiciled individuals, or what we call them US connected persons. And once you've got a green card, you are one of them. The way it taxes those individuals offshore and taxes their offshore assets in a fairly unusual way when compared with the common law countries and that we're used to, the Anglo-Saxon common law countries and the civil law countries in Europe. So one of the things that they've done is create this concept called a passive foreign investment company. And essentially this legislation was designed to target the use of corporate wrappers around businesses and investments in property portfolios outside of the US, usually in the likes of Bermuda and other tropical island type destinations. However, the way that the legislation was written, it affects any form of collective investment type structure. So unit trusts, the UK's version of OICs, European mutual funds, any fund structure that is not in the US is what we would call a passive foreign investment company. The issues with this passive foreign investment company is that the taxation is punitive. So when you hold one of these as a US connected person, you're either required to pay the tax on the growth on an annual basis, on a sort of what they call mark-to-market basis. And if you don't do that, don't report the holding, the calculation and the penalties that apply can very comfortably create a situation where you actually owe more tax than the growth. So holding passive foreign investment companies is something one's got to be very careful of. And a lot of what a traditional South African client would hold in South Africa is going to qualify as a PFIC. If you accept your green card, or you have some status as a US connected person and you're holding these types of investments outside of the US, you want to be getting some advice on that quite quickly. So what this means is that you can be holding these types of instruments if they're held inside a genuine bona fide pension. And by that, I mean like an employer related scheme, that should be fine. It's when it's held in your personal name in the form of an endowment. That endowment wrapper is not going to be recognized by the US, and therefore they'll look to the underlying funds, which again will be seen as PFICs. So there's most of your traditional investments that you would hold in South Africa will come to some bother once you have a US connected person status in South Africa. There is also the issue of a trust that sits outside of the US. That trust can be based in Guernsey, that can be a South African trust. The issue with the US trust law is that they have these concepts of a revocable and an irrevocable trust. So their concept and how they look at a trust deed is somewhat different to your traditional UK and Commonwealth countries' views of trusts. Therefore, one has to be careful not only of who the settlor of the trust is and who the trustees of the trust are, but also who the beneficiaries are and where they are. And then again, what sits inside that trust. Because if you have portfolio assets inside that trust, there can be circumstances where the trust is looked through and the underlying investments get taxed according to the PFIC rules, which can create a tax burden that definitely wasn't planned and is probably a lot higher than was expected. So what all of this really means, and what our experience of working with South Africans who are heading to the US, is that the planning process for a move to the US needs to start well in advance. And I would say probably 2 years in advance of the actual move date is when one should start thinking about this. The bigger the balance sheet, the more time there's needed for planning. As Niel has mentioned, when you overlay the issues of South African CGT and the fact that it's a deemed disposal and the actual disposal down the track will be viewed at from the US side, and these PFIC issues and the issues related to trusts, it really means some thinking needs to be done well in advance. Because sometimes what we find the answer is that assets that the individual would have chosen to keep should be disposed of before they leave South Africa. So in our experience, there's a common sort of thinking error when it comes to financial planning in a cross-border context. And one of those is that the focus is generally in the beginning, the ability to move and reside in the new country, the settlement in the new country, getting jobs, getting homes, getting all of that set up. And the financial stuff is generally dealt with in year 2 or 3 of having arrived on the other side. There's a few countries where that creates quite a few problems, and the wealthier you are and the bigger the balance sheets and the more complexity in your balance sheet, the bigger a mistake that would be if the US is your destination of choice. For the simple reason that if one can think through these and make some decisions before you go, you can actually avoid a certain degree of double taxation, and certainly simplify and plan your balance sheet to make it tax efficient for the US environment, because the US as a country is not a high tax jurisdiction like a lot of Europe. It's a reasonably low tax jurisdiction, but it taxes certain things in a very aggressive and punitive way, and one of those is foreign and offshore investments. There are ways to mitigate the US estate duties. Not all of the states, for example, have estate duty applying to them, and there are ways to use trusts in the US environment to actually manage your estate duty costs. And we see potentially on the political front that 11.4 million exemption is most likely on the way down, probably going to be halved. So some thinking is probably needed if you've got a large balance sheet, a family balance sheet. Some thinking is needed to address how best to plan for that with yourself being based in the US. There's a lot of families we've come across that, for example, have got Guernsey-based family trusts. And again, if the kids have gone ahead and started studying in the US and are beneficiaries of this trust, then by all means, you need to get some advice quite quickly, because the underlying investments of that trust and the trust deed itself need to be looked at with regard to that having a US-based beneficiary. So those are just some of the issues that we come across. To give you an idea of, and here's a great quote that Niel managed to find about good old US of A. So just walking into the question of what do we do, why Sable Wealth, and how do we help clients? Slight overview of the different jurisdictions we're involved in. We're a small boutique financial planning firm sitting within the wider Sable International Group that's offering services to South Africans and others on passports, on immigration, on residency by investment programs, on tax, on foreign exchange, and then the financial planning and investment consulting bit that my team looks after. And as you hopefully have got a sense of now, as financial planners, we're doing quite a bit more than just setting up investments for people. We're trying to help clients think through and plan for how their finances and their balance sheets and their investments should look for a long time period, and possibly the succession of more than one generation, and doing that in a cross-border context. So this is how does wealth flow through the wealth generator to the wealth generator in retirement, onto beneficiaries, and where are those beneficiaries and where is the wealth? Because the wealth can be generated in one place, be stored in another, and flow to beneficiaries in a third or fourth or fifth location. So what we do is think through those flows and the likely tax estate planning issues, and structure the investments to meet those flow through goals. The way you would structure an investment for a beneficiary in the US is going to be different for one that's in Australia or Europe. So we try to bring all of those different layers into the picture when we build structures for clients. So to give you a quick overview of our value proposition, firstly, there's planning and structuring and being done in a cross-border environment. It's a multidisciplinary service that we provide, requiring deep tax and cross-border skills, the likes of which you would have seen on Niel's side, investment skills and experience on our investment committee side. The solutions are tailored to every client. We don't have a template that we work off. We really build all the solutions around you, the client. And we do that within the context of often crossing over and providing services from other parts of the business. Sometimes we're in the process of getting a passport to a location from one of the other teams, or partnering with First Pathway on the EB5, for example. And then operating and acting for you on the solutions that we put in place in multiple jurisdictions. So just to add to that point, we've also got a business within our group called Sable Capital, which is quite new, helping for clients that are facing that planning of looking to leave South Africa and possibly move to the US with a large chunk of your wealth in a South African business. That business is there to represent you as a seller in the market and possibly do a full or partial sale. Just touching on the point Niel made about CGT. So if you're vexed with that particular problem of what do I do with my business, by all means, have a chat to us about that. We'll bring that piece into the wider conversation. And that would conclude the Sable Wealth piece. And I'll probably best hand over to Sonia at this point.
Thank you very much, Mike. That was, it actually and absolutely touched on all the points, that the investors have been asking us. And, so many times we rely on the immigration attorneys in the US to assist us, and they do a great job. But, sitting in South Africa, I didn't always have the answers. Yes, we've got expertise in terms of taxation and that, but at least, dealing with you guys, you cover the whole spectrum. And it's very good to know that you assist, business people, in selling their businesses. That is a phenomenal opportunity. And most definitely, I'll be reaching out to you in terms of that as well with one or two of our investors. So thank you very much. Very enlightening. Just a quick round off. Any optimism or anything on the predictions on the South African rand?
Sonia, what I would say on the South African rand is in people who are in South Africa who have a lot of wealth in rands are probably already quite painfully aware of the risks that carries. It's an extremely volatile currency in a commodity-based economy. And therein lies the problem for us. Our view is we're trying to help clients protect their wealth in global terms. And a lot of our clients are actually looking to migrate to other parts of the world. So from that point of view, there's no better time than today to exit your rand positions and start to globalize. Because holding out on rand positions is getting into the business of market timing and trying to predict when one currency is going to be ahead of another. And I think that's generally a very bad idea, and very few people seem to have the skills to be able to make those calls. So I think when thinking of the rand, I think one needs to look over 20 to 30 to 40 years in terms of your wealth, and try and answer the question, do I want to be holding rands in 30 years' time? If the answer to that question is no, then today is a good day to start planning to move those positions.
Great answer. Thank you very much. I'm going to touch on First Pathway Partners and show everyone a quick video on our new project. Ultra high luxury hotels being built it's called TALUS at Silver Rock. Silver Rock is in Southern California. It's on a golf course. It's got an Arnold Palmer golf course as well. What I want to do is just kick off with a video, and then I'm going to just give you a brief overview on on the actual TALUS project. Share screen, yeah.
I really enjoy our beautiful city, and what attracted me was the progressive vibe of people visiting and wanting to live, work, and play in La Quinta and the greater Coachella Valley.
It's always been known as the gem of the desert, but it's really quite true.
When First Pathway looks for a project, first we look for a great partner.
The Robert Greene Company has a fantastic track record of delivering great projects for themselves
And those that bring projects to them.
In addition to having fantastic projects, we also are experts in making sure that people make it through the entire process very seamlessly. And no matter what happens, we have that expertise to be able to give you the answers that you need right away. The Robert Greene Company is really a world-class developer.
They're excited about working with us. We're excited about working with the Robert Greene Company. And this is going to be a very, very successful project.
Silver Rock, as its own location, is really special. It's right at the base of the Santa Rosa Mountains. The landscape and the visual impact of those mountains is more than just something to look at. It's actually something you almost feel. It really is very magical.
It's anchored by the Coachella Valley, world famous.
A great place for people to go as a vacation destination. On top of that, there's the golf resort.
The golf course designed by Arnold Palmer. It's spectacular. It's like the perfect place to get away. It's like you're in another world.
We are building the Montage La Quinta and the Pendry La Quinta. We will be the first ones to actually combine those two brands in the same location.
We like the fact that you have these two brands that actually afford you the ability to have generations of families
Together in the same place, experiencing the same things.
but you get to walk away from that telling different stories.
This entire Coachella Valley is very events driven between art and golf and tennis and music festivals, that this is a needed amenity and location for all of those attractions and more.
I think one of the things that's really going to set this property apart from other things in the Coachella Valley is really the fact that this is going to be upscale luxury living.
The fact that it is fully entitled, fully designed, already under construction, gives the investor the assurance that it'll be a successful project.
The EB5 process can be very complicated, but with a great project like TALUS at Silver Rock, a great developer like the Robert Greene Company and First Pathway Partners, EB5 investors can feel confident that they're going to get their permanent green card through this process.
Because of the fact that this is a long-term relationship and we'll be working together over the next few years, to see all of those dreams come true, there's nothing better.
Thank you very much for allowing me to share our new project. It is, in our opinion, one of the very best projects that we've got. There's only a 17% EB5 investment needed in the actual project. So what I want to also just go through is just some of the highlights. Excuse me, I closed that slide. Let me just quickly open it. Share screen there. Go. Okay, so TALUS, total high, ultra high luxury, high end, 2 hotels, the Pendry and the Montage. We've also got the residences that are for sale as the EB5 project, and the sales of the residences also goes, into the actual project as well. If we have a look here, we're looking at about 40 jobs per investor, which is over 4 times the amount of job creation needed per investor to get your permanent green card. It's also, a property where there's arts culture, as mentioned in the video. The Coachella, Coachella is actual concert that's every single year. And all those residents need to actually stay somewhere. And, this is new in the area. Everything is a little bit dated. This is brand new. It caters for families. It caters for older families that don't have children. So you got the Pendry if you've got children, you got the Montage, if you like us, and our children are grown up. So yes, just a quick slide on the investment amount is $800,000. And that then obviously gives you an opportunity to your green card and ultimately citizenship. We've got 100% success rate in terms of our green card and funds returned. I think that is the most important. You've got to look at the track record of the regional center that you are investing in. And we're very confident, this is going to have longevity. It's got the actual backbone. It's already under construction. Yes, we can share definitely more about that. But today's purpose was to look at your financial side and to assist all our investors in terms of what to do. So I just want to encourage everybody, if you've got any questions, I just want to quickly check in the Q&A. I don't see there's any questions, but if you've got any questions for us, please reach out to us. So what I wanted to ask Niel and Mike before you go, you're saying you have to do your planning about 2 years before the time. But I think most importantly, for the guys that have already made their decision to invest into EB5, is it possible to actually put all the measures in place, because you've got to make your initial investment, it's got to be filed with USCIS, and there is a time period that you've got to wait for your R526 approval. Historically, and where it stands today, is 18 months before you can move to the US and get your temporary green card. But, USCIS is actually looking at shortening that period. My question to you is, would there be enough time, they call it 18 months, for those that haven't started taking those steps? I know a lot of our investors have got some offshore funds, but they are selling some of their assets in South Africa. Would it still be possible in those 18 months, call it, for you guys to assist them?
Sonia, the answer would be yes. It very much depends on the complexity of the client's balance sheet and how much history inside AIs. Yes, a lot can be done. Potentially leading South Africa and being in the US in 18 months' time, they should be speaking to someone like ourselves now to try and understand the nature of the decisions that need to be made, what the critical path is to getting everything done by the time they arrive on the other side. We can definitely do that inside 18 months. It's how quickly the client can get to a position of being comfortable to make the decisions. And that requires that the advice is there first. So we have a no fee discovery process with a client where we sit down, try and understand their needs and try and give them a sense of what this advice process is going to look like and what the key areas are going to be. So it's how quickly and how engaged the client is and how quickly they're willing to move. That's what's really dictating it.
Okay, so we've got a couple of investors that are, are looking at moving forward relatively quickly in South Africa. We've had a period where we've been waiting for reauthorization, and we've been waiting for a whole lot of changes that were implemented in terms of USCIS. But, we have got our investors that are ready to proceed, which I'm very happy to say. And as you all know, we're here for you every step of the way. And yes, most certainly, I would appreciate your assistance, and I will introduce you to, my investors that would need your help. And I would just like to say to you, Niel and Mike, thank you very much for today. It's been very enlightening, and these are actually the questions that we needed answered. So thank you very much.
It's an absolute pleasure.
Great. Thanks, guys.
All right, thank you, Mike. I really appreciate it. It's great to meet you. And if you need anything, just please don't hesitate to reach out.